Hey everyone! Welcome back to our channel, where we make money simple and help you make smarter financial decisions. Today, we're diving deep into personal loans, what they are, how they work, and whether you should actually get one. By the end of this video, you'll know exactly how to use a personal loan wisely, avoid common traps, and even boost your credit score along the way. So grab a coffee, hit that like button, and let's jump right in. Part 1. What is a personal loan? So first things first, what is a personal loan? A personal loan is a lump sum of money you borrow from a bank, credit union, or online lender, usually repaid in fixed monthly payments, called installments. Unlike a car loan or a mortgage, a personal loan is unsecured. That means you don't need to put up collateral like your house or your car. Instead, the lender decides whether to approve you and what interest rate to offer, based mainly on your credit score, income, and debt-to-income ratio. Part 2. How personal loans work. Let's say you take out a $10,000 personal loan at an interest rate of 10% for 3 years. Your monthly payment would be around $323, and by the end, you'll have paid about $11,630 total. That's $1,630 in interest. The two main components of your monthly payment are: 1. Principally the actual amount you borrowed. 2. Interest, the cost of borrowing that money. Most loans have a fixed rate, meaning your monthly payment never changes. Some have variable rates, which can go up or down depending on market conditions. Personal loans are great because they're flexible. You can use them for almost anything. Debt consolidation, home renovations, medical bills, starting a small business, or even a dream wedding. But, and this is key, just because you can take one doesn't always mean you should. We'll talk about that next. Part 3. When should you take a personal loan? Alright, let's talk about good reasons to take a personal loan versus bad ones. Good reasons. Consolidating high-interest credit card debt, for example, swapping 25% credit card interest for a 10% loan, paying for an emergency expense that can't wait, making a home improvement that adds value. Bad reasons. Financing luxury purchases or vacations, covering ongoing monthly expenses. That's a red flag. Your budget needs a fix, not a loan. Investing in risky assets like crypto or stocks with borrowed money. Never do that. If you're using a personal loan to save money or invest in yourself, it can be a smart move. But if it's to fund lifestyle inflation, it'll only make your financial situation worse. Part 4. Interest rates and credit scores. Now, the interest rate you get depends largely on your credit score. Here's a rough idea of how rates vary in 2025. Excellent credit, 750 plus, around 8 to 10%. Good credit, 700 to 749, 10 to 14%. Fair credit, 650 to 699, 15 to 20%. Poor credit, less than 650, 25% or more. Lenders look at your credit utilization, payment history, and income stability. Pro tip: before applying, check your credit report for errors and pay off small debts that can bump your score fast. Also, applying for too many loans in a short time can hurt your score, so compare offers through soft pull marketplaces like LendingTree, Credit Karma, or Bankrate. Part 5. Secured versus unsecured loans. Most personal loans are unsecured, but some lenders offer secured personal loans. That means you'll put up something valuable, like a savings account or your car title, as collateral. Pros: lower interest rates, easier approval. Cons: you risk losing the asset if you can't pay. So unless you really need that extra approval boost, unsecured loans are usually safer. Part 6. Loan terms, fees, and fine print. Always read the fine print before signing. Look out for origination fees, 1 to 8% of the loan amount, deducted upfront. Prepayment penalties. Some lenders charge you for paying early. Crazy, right? Late payment fees can add up fast and hurt your credit. Ask your lender for a full APR, not just the interest rate. APR includes all fees, so you know the true cost. Part 7. Alternatives to personal loans. Before jumping in, consider alternatives. 0% APR credit card offers, great for small balances you can pay off quickly. Home equity loans or HELOCs, lower rates, but they use your house as collateral. Borrowing from your 401k, not ideal. hurts your retirement growth. Peer-to-peer or fintech lenders, sometimes faster and easier approval, but watch the fees. Part 8. Smart tips for borrowers. Here are some smart tips if you're taking a personal loan. 1. Borrow only what you need. 2. Choose the shortest term you can comfortably afford. Less interest overall. 3. Set up autopay to never miss a payment. 4. Avoid new credit while repaying. It helps your credit score. 5. And always compare at least 3 lenders before deciding. So, that's the full breakdown of personal loans, what they are, when to use them, and how to avoid the pitfalls. If this video helped you, give it a thumbs up and share it with a friend who's thinking about taking a loan. And if you want to see my next video, where I compare personal loans versus credit card balance transfers, make sure you subscribe and turn on the bell so you don't miss it. Thanks for watching, and I'll see you in the next one.